Dear investors, my name is Joshua Tan, strategist at Phillip Securities Research. Global recession risk remains elevated. New export orders for the Eurozone, China and Singapore are in contraction, while the US is borderline. The Eurozone has quite likely entered recession already, while China is facing headwinds not just externally but from an investment slowdown as well. The US has had improvements in consumption, but we do not see this as sustainable given that fiscal supports are unwinding and the savings rate is likely to revert back to average. These will conspire to offset wage and job market gains. Singapore is, in our opinion, liable to put in not just negative on-quarter growth for third quarter, but fourth quarter as well. It's quite likely we not only have a technical recession on our hands, but a real one in the works. Non-oil domestic exports for October were shockingly bad. We maintain that the larger trend for the STI remains bearish. On top of this, the Eurozone situation is on knife's edge as Italian bonds remain under selling pressure. Italian yields have shot above 7% twice already and came down only after the ECB intervened. Reports are that apart from the ECB, there are no buyers. We wish to highlight that the ECB cannot do this indefinitely as it is under mandate to maintain a quantitative easing effect of zero. If it buys something, it must sell something else to neutralize the monetary effect. Soon it will run out of other assets to sell. The ECB will not conduct open monetization of a member's debt unless there is collective fiscal oversight over the offending country. But what else is that but the road to fiscal union? We maintain that fiscal union is the best outcome to this crisis, as shared budgets and a shared debt will alleviate pressure on individual countries and will also enable the channeling of resources of competitive nations to reconstruct uncompetitive nations. But it remains to be seen if Germany especially is willing to enter another long period of reconstructing failed states, after having spent the last 2 decades reconstructing the former East Germany. The alternative, however, is a euro breakup, and under any permutation of a breakup will minimally entail a bad global recession at best, a global financial crisis at worst. We are therefore looking out for a roadmap to fiscal union as a key positive for markets going into 2012. Otherwise, the outlook is decidedly bearish. Of the STI component stocks, telcos Singtel and StarHub offer best relative share price resilience, but we note still corrected 50% and 40% respectively on an absolute basis in the last bear market. Thank you for listening to PhillipCapital Market Watch and tune in next week.